Well, it looks like we're on the starting page of our previous discussion with the problems, but actually I just want to go back over it a moment with you because one of the things which we are doing in this chapter is recognizing that all financial instruments should have an interest and in a principal component. And if you don't have that component showing up, you will have to create, of course, a discount so that you have the interest. And if the interest is not reasonable or it's not to market, then of course you're going to have either premium or discount depending on which case it is. And this then is a continuation of that. So the problems we had, we created tables for. Now we're going to move into the journal entries for those. So the next page is going to show that. Then we have the one where we had a non-interest bearing note as payment for the automobile. And in this, we recognized our discount in our initial journal entry. And here is that initial journal entry. And you notice that this journal entry, I say period 0, it would be replaced with the actual date on which we signed the note. And when I say period 1, that would be the interest interval. And bearing in mind, if it's non-interest bearing, you should use actually the year anniversary date for the removing of that discount. And as we have said previously, that this discount that is removed technically should be removed a little bit every day, a little bit every month, a little bit every quarter. But in practicality, what happens is it's time for you to do your financial statements. You adjust your discount and bring it up to date before you do your financials, which means also you bring your interest expense up to date. So a portion of this interest expense, which is here under period 1, you would accrue or you would record a number of months, whatever is appropriate for your financial statement. And you wouldn't just do one journal entry. It's simplistic to look at it this way, but we do it this way for teaching purposes. So the first journal entry that's done is done when the automobile is brought back home to the business, and we record the automobile not at $10,000 but at a lesser amount because we understand that part of the amount we are paying is actually for interest. It's presumed to be the interest that would have been earned by the individual or the company that is making the loan to us. So we put that in at $3,194.20, which means the total amount of interest expense over this time period of 5 years needs to total up to $3,194.20. However, it will be proportioned. Using the effective interest method, then for each period of time, that interest should be in some proportion to the carrying value. And we said that's the general rule, is to take carrying value at the end of the previous time period, multiply it by the market or reasonable rate to come up with the interest expense. In this case, we only have one component of interest expense, and that is amortization. And the amortization amount is coming from our table, which we have calculated and completed up here. So once you complete the table, then you can do it. I'm not quite sure what happened in my table there for period 4. But whatever the balance is here needs to be removed. So as you work through the table, whatever you had when you completed it, that needs to be the last one, which is done. And this amount that you do for should be the total of the balance which remains in your discount at that date. the very same date is the date which you are going to be paying it off. So you pay it off, and this journal entry down here, by the way, if there were a premium, if there were a discount, if there were no premium or no discount, this last journal entry would be exactly the same because you are just paying off the maturity value in that journal entry. There's no premium or discount to be concerned with at all in that journal entry. The next problem we had was where we had an 8% market rate and we had a 2% being paid. And we worked through this problem. We recognized that we are going to have a discount. The discount is going to differ here because in this case we have actually some part of interest being paid, and we have to somehow account for the other 6% that isn't being paid, and that somehow needs to affect us in our initial carrying value for that automobile. As I said previously, we don't really use the 6% anywhere in our calculations. We are going to discount things at the market rate. We are going to consider it the 5 periods of time, and we're going to build our table, and we're going to build it off of the calculations, and we made those in the previous part of this packet. So now we have the journal entries, and you can look at this and you can say now, because it has a discount, we have 2 parts to interest expense. We have the amortization part and we have the cash part. And when you have a discount, these are both true debits to interest expense. So there are 2 debits to interest expense, if you will. We combine them into one journal entry, and the one journal entry for the first period is going to be a debit to interest expense for 608.35. So you can see that by looking at this, can't you? The other thing I want to talk about again is that when you get down to the 5th period, you notice that we have 555.60 left in the discount. Well, we need to get rid of all of that within the next year because this is done yearly here. We want to get rid of all of that in the next year. Instead of then having an amortization amount here of 555 and 55 cents, which is on line 5 here, we need to actually get rid of all of that, and we would do that. When we calculate our interest expense, then interest expense is the 200 from the cash, but it's also 555.60 for the amortization of that discount. And I'll go on down here a little bit and we will look at our journal entries. So the initial one, which we discussed previously, is to put that automobile on the books, and this automobile gets a higher value because we are actually paying some of the interest, and so we have less to put into the discount, if you want to look at it that way. The note payable gets recorded always at our maturity value, but the discount goes on to reflect the time value of money components. So the carrying value is a carrying value which is valued using present value concepts, which is appropriate because it's a non-current. The amount of cash is going to always stay at 200, and remember how to calculate that is based upon maturity value times the stated rate. Interest expense here is the previous carrying value, so in the first instance it's this carrying value times the market rate, and you can always tell the market rate by going up and look at your present value calculations. We come up with 608.35 for that. We know cash is 200, and the plug number to make the balance sheet, the journal entry in balance is to come up with a credit for 408.35. If you have the first journal entry on your page and then you go on and you do the amortization, because you've created a debit balance, you need to credit to get rid of it. And when you credit, it's 408.35 to the credit there. which means your discount is being reduced. You need to reduce the discount over the total period of time again so it becomes zero. And it's a matter of filling in the rest of the numbers. And the last one, journal entry, by the way, is always, as I said before, the very last journal entry is to remove the maturity value, or in the case of bonds, the face value. We can go through this and we can look at the situation where our stated and our market are the same, and we can calculate the interest expense and say interest expense in this situation is carrying value at the beginning of that period of time times the market rate. And when we do that, we come up with $1 million. We can say that the cash paid is stated interest rate times the face value, or the amount there that has been borrowed, and we'll still come up with the same number, because in this instance carrying value and face value are the same, and because market and stated are the same, we always come up with the same numbers. So we could go to the trouble to build a table, or we could just say, since it's the same, we can use what we know in establishing current liabilities and apply that, because the same concepts will apply. We don't have to do it. We do not have to do the present value calculations. If we did present value calculations, though, we would indeed get the same numbers. Now, we have stated, which is greater. This is the one that's the by far the most confusing one. So when we do this, we come up with a situation where we have two credits. We have a premium and we have the bond itself. Then we need to go through and we need to remove the credit, the premium, by debiting it. And we need to keep or get the carrying value at the end down to the 10 million, because like the other problems we've had, the last journal entry needs to be the journal entry which takes it away. So whatever we had in our premium account is going to be the amount that you're going to remove when you get down to period 4. I didn't have the periods in the table, but we know that this one is 0, this is 1, 2, 3, 4, and 5. So whatever is here needs to be removed, however you do that, and whatever number you come up with. So we get cash in. We are going to have to repay the 10 million, so that's what we put in bond payable. So I should say, when you do these journal entries and you do your initial recording, and you have either a note payable credit or you have a bond payable credit, that amount represents the amount you're going to have to pay at the end. I've also referred to it as face value when it's bonds, and I've referred to it as maturity value when it's notes, and those are both appropriate. Premium is going to be the credit. You got recorded as a credit, which means to remove it, you're going to have to debit it. This is tricky because when we look down here, we say that yes, interest expense is coming from two things. It's coming from the cash payment, and it's coming from the amortization of the premium. However, amortization of premium actually would be a credit to interest expense. So if you could take this journal entry apart, as I did previously, you would see that it is interest expense debited for $1 million, cash credited $1 million, and then it's premium debited for $136,119, and interest expense credited for $136,119. So the net amount of interest expense from those two separate journal entries gets created in this one journal entry. The reason why I don't show the two separate journal entries is because I want you to understand that when you have those two journal entries and you combine them, the net interest expense from those two journal entries, it still follows our rule. The 863,881 is the carrying value of 10,798,510 times the interest rate. That will get you to 863,881. Cash is the amount of cash that you have to pay in interest. And if you have, again, a debit for 863,881, a credit for $1,000,000, the net is going to need, you're going to need a debit for 136,119 to make it balance. When you put that in, if you just look above it, you see that you created a premium as a credit, therefore you need to debit it. So there's a number of ways to get at the journal entry, and I tell students, write it down, use what you know, think about it. The journal entry has to be equal. It has to be equal. And it helps too to recognize, or to think about, I should, when we say recognize, we mean doing initial journal entries. So it helps you to think about this and say that when you have a discount, you have two sorts of interest expense, one from amortization of discount and one from the cash flow, and that they are actually true debits to interest expense. When you have a premium, you are really reducing interest expense. So a premium is like an aberration from the other. That might be helpful. Again, there's a number of ways to get at this, to reason with yourself, to keep it in your head. The same standard journal entries are being done here, but notice because it starts at a premium and it has a high value above its face value, carrying value is above the initial face value. Then you see it just goes down, down, down. The carrying value is reduced until it gets to 10 million. So interest has to follow the same pattern. It's going down through time. So with the premium, your interest expense is going down through time. It becomes less each time. And with a discount, it becomes more because carrying value is going up to the face value. Then the very last journal entry is done to remove it. Again, what you would do is you would go back and you would put in the dates, and since this is annual, it's just a matter of being, say, 1 year of year 2000, the next year 2001, etc., all the way down. If you had bonds that were semi-annual, you would have not 5 periods of time, but 10, and you would have half the amount of cash interest being paid. Your interest expense would be using half of the market rate when you do that calculation. Again, with this one, if there's something in between the time periods of your financials, you need to update your premium account. You need to update your interest expense, and you need to record an interest payable. We can go through another problem, and I would suggest that you work your way through this on your own. If you come out a little bit different in your numbers, and you come off by a different amount than my 47 or whatever, it's due to rounding, or it's due to you using a calculator. I wouldn't be concerned in the least about it. You notice this one, we don't have cents on, we've just used dollars. That's appropriate too. The journal entries, you just get used to doing these journal entries, and notice the form is always the same here. Since you have a discount, your interest expense is coming from two sources. Cash amount's always the same, and then the last journal entry is always the same too. This one is about the differences between recording current and long-term notes in our initial recording, which is the recognition. And we are assuming in the problem that we have $100,000 in notes. And in the first case, it says record the journal entries. It's due in 9 months, and she's paying the market rate. Well, she's paying the market rate. It's 9 months. There's no issue here. We're just gonna record it for the 100,000, right? So the first thing to do is determine if it's long or short term, and then the issue sometimes becomes the market rate. In the second one, for example, up there in B, we notice it's a non-interest. Well, that means it isn't the market rate. And for this method, though, because it is non-current, you are not going to use present value calculations. Yes, technically we should, but we are permitted an exemption, if you will, for that, an exception. We get to use just the maturity value, and then we do some type of a shortcut which says calculate the total amount of interest and on the 100,000 given the market rate, and then subtract that from the 100,000 to figure out what our discount needs to be. So let's go through these then. First one is going through and saying just record it standard cash, debit, and note payable credit. The next one is a current liability, and the interest will be paid at the end of 9 months. The calculation for that is going to be, now this is a little tricky here, but it would be 9/12. So you need to take 9/12 times, we're going to assume it's 10%, 9/12 times 10% times the 100,000. And that is how they come up with the 7,500. Recall from this chapter also that when we use effective interest method, when we use my words correct here. In the previous module, when we're using these current liabilities, we said the actual interest then would be higher than 10%, because you need to put the 7,500 on top of the amount which is actually coming in, which is 92,500, and you would see that that number is actually greater than 10%. So we went through that calculation and we proved that. All right, so now we have a discount, and what needs to happen to the discount? This is another important distinction between last chapter or last module and this one, is the 7,500 needs to be removed equally over the 9 months. There's no effective interest method used here because there's no present value calculation here. So we just do a straight line removal of the 7,500. Contrast that to this chapter. In this chapter, a straight line amortization method applied to discounts or premiums is considered an exception, and you only can do that if there's not a material difference between the straight line and the effective interest method. In C, the bank agrees to lend them for 3 years at a market rate of 10%. 3 years, market rate 10%. Well, that's easy. If the market rate is equal to the stated rate, you treat it as if it were a current liability, and you're able to just go in and do your shortcut that you all know how to do, which is the 100,000 and the note payable. So in other words, this C got recorded just the same way as A, and A is a current liability and a note paying interest that we assume is reasonable. So the only problem you ever come into is when the interest rates are just not in sync, right? So now the next ones, they lower the interest rate to below market rates. If it's below market rates, you need to think about the cash flow. So you're going to have to go in here and figure out the cash flow associated with the thing and come up with the values for that, and find that the discount here is really 2,487.35, which will show up as interest. And the point I make here also is, does it really pay to renegotiate a long-term note at below market? And it's really not going to show up, because what's going to happen is the amount of the value that gets recorded initially is going to still be representing the market rate. How do these get disclosed or show up in the financial statements? It's another good review. The 100,000 will show up as a current liability, and it will show there until it gets paid off. We can do on our current liabilities, you can show it as a net amount, or you can show it net of discount. The point is that the carrying value needs to include the discount or show the discount, and that it will decline and it will change. With this on C, which was a non-current liability, you need to recognize the part that needs to be paid in the next year is going to be a current liability, and likewise the current portion of the other one needs to be recorded as a current liability. And so what you need to do with these that are non-current is you need to go through and you need to say, how much am I going to pay in the next year? And that has to be reclassified. And you also need to do it for the discount. So you need to take the discount, put the discount, how much of that is going away in the next year, figure out that is the current part of the discount, and you have then the face value, how much of the face value is going away in the next year. And so with these, if you're just paying a lump sum at the end, guess what? Then it all is going to be long term until you get within 1 year of when you're going to have to pay it off. And when you get to the point where you're going to pay off that face value within the next year, then that classification of that thing is going to show up as current because it's going to be paid within the next year. So, more problems there. Food for thought. Debt issue costs must be capitalized and expensed over the term of the liability. How do you do that? Well, you would show it as a bond issue costs, and you can use the straight line method as long as that is not a material difference between putting it in for your with your discount and increasing your discount. Usually, in the way I'm going to want you to do, I'm going to want you to increase your discount or reduce your premium and then amortize it, including it as interest expense. Okay? So this is the former treatment. The former treatment had us doing a debit to an asset and taking it off straight line. This has been changed, and so now what we need to do, this is a bit of a controversy, but the now we need to do is we need to include it as a part of the discount or a reduction in the premium, and it flows through interest expense. Formerly, we treated it as the debit to an asset account, debt issue cost, as up here, and then allocated it on straight line. We do not get to do that anymore. Only if it's no material difference between that way and the new way can we do that. The new way has us adjusting our discount, increasing the discount, or reducing our premium and taking the difference through as an adjustment as we would when we do the effective interest method. Commonly used methods of determining interest. The effective interest method, remember, is using the market rate of interest times the outstanding balance. And remember, I said that's becoming the balance is the beginning period balance. And in the case of the first period, it would be the initial carrying value. So we have to do the accrual concept, and we have to accrue things, and we have to record a payable if we're paying the interest, and it's an amortization. The exception, we are allowed to determine interest by allocating equally over the term if doing so produces results that are not materially different. So, and then guiding principles, as I said before, is whether it's misleading. So if you have a big amount of premium, big amount of discount, you probably won't be able to use a straight line. You will probably have to go in and use effective interest. In this class, I demand you learn the effective interest method. This is figuring out pricing under these different ones. This is just a review for you, so I'd go through and review and see if you can come up with these and calculate these things. I would go in and look at the tables only if you really have a problem with working through tables. And again, pause this video and look at things. Here again, review journal entries. If you have a discount, you have two interest expense that combine in the same direction, and one is from the cash paid and one is the amortization, because if you have a discount, the carrying value increases, the total amount of your interest expense needs to increase. So you may have to revise the amounts you have in your journal entry for the last period of time to reflect an additional amount, to remove an additional amount from your discount account. And those are all associated with what we had there above. This is converting liabilities to equity. So we have convertible bonds, and they initially went on the books at 101. Whenever you see a 101, that means 101% of carrying value. So you had 6 million of these bonds. So 101 means that you need to take 1.01 times a 6 million to get the amount. And the bonds are convertible into bonds that are similar in all except that they are non-convertible, currently are selling at 99. What should they record of equity and how much a liability when they are issued? What we need to do is put the entire amount as the liability. I said before, the only time you get to you record part of that as equity is when they are actually converted. So it doesn't matter if they tell you that they are non-convertible or currently selling at 99. We have no belief that they will convert or they won't convert. Therefore, you're going to record those as bonds or liabilities. So as the solution tells us, we are not going to record any equity and put it all in there as a liability. Then if it does become stock, I want you to remove this bond. And before you remove it, you're going to do exactly as we said. If you retired a bond early, you're going to update any discount or any premium for amortization. And you're going to update those accounts, remove it, and then you're going to create equity to replace the bonds. This is all I'm requiring you to know for your exam purposes. Installment notes. How do these differ from the other examples we have had? When notes are paid in installments rather than a single amount, you are actually paying equal payments over a period of time. It can be an annuity due, or it can be an ordinary annuity, depending on when that payment comes. If it comes at the beginning, it's a due. At the end, it's ordinary. We are still going to calculate interest expense as the outstanding amount, the beginning of that particular time period, times the market rate. But the periodic payments are larger, and there is no lump sum payment at the end of the time period. And when we do installment notes, the installment notes more appropriately relates to a capital or a financing lease, which we will cover in the next chapter. Fair value. Here they have bonds outstanding, the market rate rose. So if market rates rise, then we know the security prices fall. That's something you learned probably from finance. However, as I said earlier in this module, doesn't affect our amortization schedules, doesn't affect our initial recording, doesn't affect any of those journal entries in between time points. The only thing it possibly affects is if we were to retire it early and we have gains or losses, or if we are going to use the fair value accounting methods. Those are the only times it might have any effect on us. So in finance, you're always thinking about what's interest rates doing, how's that affecting the investment in debt securities or whatever the investor is having. And and I think you even talk some about stock prices and bond prices and their interchange. But in this class, we really don't care about it until it is the point at which we're doing our financials, and then we only care about it if the company has elected to use the fair value option. Because if they do, then you're going to look at it and you're going to say, well, if my book value is such that I'm going to have to reduce the value of a liability, that's a good thing, so that's a gain. But on the other hand, if a fair value rises in a liability, in contrast to an asset, if the fair value of an asset rises, it's a good thing. If the fair value of a liability increases, that's a bad thing. Okay, so that means it's a loss. And we discussed a little bit the rules there about whether it goes to OCI or where it shows up, and there's another discussion of it here. Debt issue costs, how you would actually work a problem with debt issue costs. So again, you don't do the straight line with debt issue cost unless there's not a material difference. So I'm going to ask you to use the standard provision which says there is a material difference in doing straight line versus the required gap. You got to use required gap. In other words, required gap is going to say that you should take the debt issue cost. In this case, it's $14,000, and you should show that as an additional discount. So in this case, they issued 700 $1,000 face value bonds at 95.2333. And so that means that 0.95233 times 1,000 times 700 is going to get you the value of those bonds. This is a discount. And when you incur $14,000 in debt issue cost, this causes any discount that you have to increase. And you say, well, how in the world am I going to work this problem? Because I just don't know how to work the problem. Well, you're going to start out with an initial book value which reflects the discount, which should also include the 14,000. So the 14,000 should be included in the discount. So you, in effect, are going to change the interest rate to make it all work. And I'm never going to ask you to work through a problem like this. I just need for you to understand that when we have debt issue costs, they are in effect the same thing as a new discount or reducing any premium that you have. And you're going to have to put it in your table, and you're going to have to go through, and instead of actually having an item and calling it debt issue cost and expensing that item on straight line basis, which you might have done in the past, you're not going to do that. You are going to take it out of the discount or adjust your premium amortization for it, and you are going to show it then as an interest expense. So the initial carrying value, the journal entries, the interest expense, and how you do this is recorded within the table. So you actually create this discount to include the 14,000 that's being paid. So when you create the table and you amortize it and you go through the table, you need to work through it so that at the very end you should end up with, this should be 700,000. So you see it's pretty close, right? So you work through the table so you end up with the amount. We're some amount off here, 80 some cents off at the very end. Pretty good. So same standard journal entries, except you now know that when you have discount, the discount will include the amortization, or the bond issue costs. Again, I would never ask you to work through a problem like this. I just want you to understand the appropriate handling for debt issue costs is to create a greater discount or to reduce a premium if you have a premium. You would never, again, have premiums and discounts on the same bond. Either have one or the other and adjust it accordingly. I'm going to go ahead now and look at the end of the chapter discussion a bit, because, and yours may differ a bit from mine, but I want us to just go back over the important parts to this chapter. Liabilities are those things that reflect a creditor's interest in the company, and you should accrue interest just like you should go through and record accruals when you have discounts, and when you have premiums you need to accrue that interest as well as the cash interest. And when you have a present value and you take a present value, which is the appropriate thing to do with long-term debt, there should be then interest on it. It's hard to do present value without interest because that's a part of the table, right? With bonds, there's a discussion here about bonds, indentures. There is a discussion about how you record it. A new thing I added at the very end was this discussion of what it means to have 97 versus 102. 102 means it has a premium. 97 means it's a discount. And I'd said this means 97% of the face value, and this means 102% of face value. Understand all important how to get to interest expense. We all should know how to get to interest expense. And then straight line is only acceptable If it is not a material difference, there's that. Debt issue cost, and the combined valuation account is reported in the balance sheet as a direct deduction from the liability. These costs are added to the discount or subtracted from a premium. That's appropriate for us to do that. And in the problem preceding, they discussed the straight line method, and they also talked about putting debt issue costs in an asset and expensing the asset off. This is no longer GAAP. GAAP says the debt issue cost should reduce the premium or increase a discount, and they should go away using the effective interest method. Discussion here on long-term notes, notes issued for cash or notes issued for assets or services. If you have an unrealistic interest rate, you're going to find that the asset that you record on your book is going to have an adjustment to it, because a part of the total value that's going to be paid back at the end is going to be actually the financing, and a part of it will be paying for that asset. Installment notes is something we are going to cover again, so I encourage you to review this. It's not of great importance for this chapter, but it becomes important for our next module on leases, because leases at times are considered installment purchases. And if you record them as installment purchases, and there's some rules we get into on that, then you will recognize, or see, I should say, the relationship between our accounting in that chapter and a purchase using an installment note. There are a lot of disclosures associated with long-term borrowings, including when they're going to retire, and they're going to have some information about the payments that are going to be coming up in the next 5 years. And this is just so that the creditors or investors can see this, and they can understand what the future cash flow situation is going to be for the company. There's a discussion here of the decision maker's perspective. I don't really cover that too much in this class. You may have a bit of it in your smart book. Early extinguishment of debt I covered, and I said that what you need to do is bring your book value up to date, and then when you get to your book value, you're going to consider the amount of cash credit you're going to have to do, and then the debits and credits to remove that liability, and the difference is going to be a gain or loss. Where it shows up depends on what it is and then meeting the criteria of the income statement. Convertible bonds are debt. They are debt. I don't require you know IFRS, so they are debt. If you have bonds with detachable warrants, however, the warrants get a separate valuation. I think we cover this later when we get to our equity and start talking about equity at the end of the semester. The option to report liabilities as fair value. You do not go back and change your tables. You do not go back and do anything there. You merely go in, and generally it will be an OCI adjustment, which is recorded net of tax, by the way, and it is an adjustment to a carrying value. So I consider these, I don't want to say exactly temporary accounts, because we often refer to income statement items as temporary because they're closed to retained earning. It's not that sort of a temporary account. It is an account that you're just going to use for valuation purposes. So you'll be debiting or crediting a valuation account and debiting or crediting OCI. and the amount will be net of tax. And you will do this only when you do your financials. So reverse the one you did previously and do a new one every time. Discussion about bonds issued between interstates may be relevant for you when you take the CPA exam. I don't cover it that much in this class. Studying for the CPA exam, this will be something that will come up then. And then troubled debt restructuring is another issue. At some point, if you're studying for the CPA exam, you would need to study. It is again a topic that I'm not covering in any way in this class.